In this video, we will be talking about the pricing and valuation of equity swaps. This video is a follow-up video of another video on equity swaps in which we talked about the mechanics and the variations of equity swaps. The link for that video is given in the description below. Now what I have done here is that to illustrate how pricing and valuation of equity swaps is done, I have borrowed the same example that we talked about in the previous video. In this example, we had a hedge fund which has initiated an equity swap with its preferred investment bank. The reference asset for this equity swap is the stock of Apple, and the notional amount is $10 million. In this equity swap, the hedge fund will be periodically receiving the equity-based cash flows. You can call it the equity leg. And in return, periodically, this hedge fund will be paying fixed cash flows. You can call it the fixed leg. Okay? Now, in that video, we had said that at the inception, the initiation of this equity swap, the investment bank carries out the pricing of this equity swap, which means that it calculates the annualized fixed rate of interest such that the value of this equity swap to both of these parties involved is equal to 0 at its inception or initiation. That means the swap starts out as a fair swap to both parties involved. Now in this video, let's do this. Let's dig deeper into what sort of calculations this investment bank would have done to arrive at this value of R fix, okay, which is equal to 1.8% per annum. For this purpose, what I have done is that I have drawn out the cash flow diagram for this equity swap from the investment bank's perspective. Recall that the maturity of this equity swap was 1 year, and exchanges between these two parties, they happened every 3 months. Okay, therefore, in total, we have these 4 settlements or exchanges happening. Okay, now the investment bank is periodically receiving these fixed cash flows. These cash flows are calculated simply as the product of the notional amount, this times the accrual period expressed in years. Because this period is 3 months, this tau, which is my accrual period, will be equal to 0.25, and this times the fixed rate of interest. For the moment, let's assume that this R fix is not known to us, and this is our objective actually, to calculate this R fix so that the value of this swap is equal to 0 for both parties involved. Okay, 0 value at initiation. Okay, now these 4 cash flows, which are inflows for my investment bank, these cash flows are certain cash flows. These are fixed cash flows, and therefore accommodating these cash flows into the value of this equity swap as of this point in time is actually quite straightforward. All we have to do is we have to calculate the aggregate discounted value of these 4 cash flows using the current term structure of interest rates. Okay. Now, if I were to talk about the cash outflows, okay, these cash outflows are essentially linked to the performance of the stock of Apple. The 3-month returns which are offered by this stock. Okay. Now, as of today, let's assume that the price of Apple is S0. Let's say it's given to be $200, and as of these future points in time, let the price of Apple be denoted by S1, S2 all the way till S4. The return for this first period would simply be S1 over S0 minus 1. The return for this period will be S2 over S1 minus 1, and so on. What the investment bank pays to the hedge fund is not just the percent return, but rather it pays the percent return that times the dollar notional amount for this equity swap. And therefore, this cash flow can be thought of to be a dollar return. Okay. Now, as of this point in time, since we do not know what S1, S2, S3 and S4 will be, therefore, the 3-month returns for these 4 periods are not known to us at this point in time. These can be thought of to be random variables. Okay. The question therefore that arises is that how do we accommodate these 4 cash flows which cannot be determined as of today into our valuation? Okay. For this purpose, we can use a very simple trick, and this is to actually put on or superimpose on this cash flow diagram offsetting pairs of cash inflows and outflows occurring at each of these 4 points in time, and each of these cash inflows and outflows, let them be equal to the notional amount of this equity swap. This is what I'm referring to. Okay, these are my dummy cash inflows and these are my dummy cash outflows. These cash inflows and outflows, they perfectly offset each other at each of these 4 points in time, and hence these dummy cash flows do not affect the valuation of my equity swap. Okay. Now, the benefit of including these dummy cash flows is that if I were to take these 2 cash flows together, this is my dollar return for the first period and this is my notional amount. If I were to aggregate these 2 cash flows, what do you get? This guy is simply NA times S1 over S0 minus 1 plus this guy is NA. If I were to combine these 2, I get NA times S1 over S0, which can be thought of to be NA over S0 times S1. NA over S0 can be thought of to be the number of shares of Apple that can be purchased if I were to invest these many dollars into the stock of Apple as of this point in time. And NA over S0 times S1 tells me what is the liquidation value of this position that I am undertaking at this point in time, right? Number of shares NA over S0 times the value of each share, which is S1 at this point in time. Okay, so by including this dummy cash outflow and combining it with this dollar return, I move away from working with this dollar return alone to working with what can be referred to as a liquidation value. Okay, now this guy can very well be achieved by the investment bank by investing these many dollars as of this point in time into the shares of Apple, right? Similarly, this combination of dollar return and this dummy cash outflow of NA, this combination which can be thought of to be a liquidation value, this combination can be achieved by the investment bank by investing these many dollars into shares of Apple at this point in time, right? This is because at this point in time, these many dollars would get you NA over S1, these many shares, right? At this point in time, if you were to liquidate this position, you will get NA over S1 times S2, which is basically the sum total of these 2 cash flows, the liquidation value that we just now talked about. Okay. Similarly, these 2 cash flows can be achieved by the investment bank by investing these many dollars into the shares of Apple at this point in time. Okay. So all I'm saying is that by introducing these dummy cash outflows, the investment bank will be able to achieve these cash outflows, these liquidation values which we have here, by a planned investment into the shares of Apple of amounts and timings which are shown here. Okay, this investment will get you the liquidation value at this point in time. This investment gets you the liquidation value at this point in time, and so on. Therefore, by using this simple trick, which we've actually done away with those random kind of cash flows which we could not calculate with certainty at this point in time, right? And now to calculate the value of this equity swap, all we have to do is we have to discount all these cash inflows and these planned investments using the current term structure of interest rates and the discount factors which come from this current term structure. Okay, and this is what I have done here. See, the value of this equity swap as of this time t equal to 0 is simply equal to the aggregate present value of these 4 cash inflows. The notation here is that df1 is basically the discount factor for the first 3 months, df2 the discount factor for 6 months, df3 discount factor for 9 months, and so on. And then from it I have subtracted the total, aggregate present value of these planned investments into the shares of Apple. And this is what I have here. Okay, and because I want to calculate what this R fix is, basically I am equating this value of this swap as of this point in time to be equal to 0. Okay, in this equation there's only one unknown, and that's R fix, and you can easily calculate this R fix. Now please note this, that in this equation you will have a number of cancellations that will happen, and these cancellations are actually quite evident in this diagram itself. This guy, it cancels with this guy, it cancels with this guy cancels with this guy. As far as my cash inflows are concerned, what I am left with is this guy, this guy, this guy, this guy, and this guy. If you were to look closely at these cash inflows, well, these cash inflows can be thought of to be the inflows which come from a hypothetical long position in a fixed coupon bond whose maturity is equal to the maturity of my equity swap, whose periodicity of coupons is the same as the periodicity of exchanges in this equity swap, whose coupon is equal to the fixed rate of my equity swap, and whose face value is equal to the notional amount of my equity swap. Okay, after I do all these cancellations, what I am left with is the value of my equity swap at this point in time is equal to the value of this long position in this hypothetical bond minus this planned investment into the shares of Apple as of today. These investments in the future, they all have cancelled out. Okay, therefore if I equate this value equal to 0, it's the same as making sure that the value of this hypothetical bond with coupon equal to R fix, maturity 1 year, periodicity 3 months, and face value equal to the notional amount, the value of this fixed coupon bond equals the notional amount of this equity swap. Okay, this is my guiding equation for calculating this R fix. If you were to do the algebra and write down what R fix is, this is what you will get. R fix is equal to 1 minus the final discount factor, the whole thing divided by the sum of the discount factors for all these periods, these 4 periods, 3 months, 6 months, 9 months, and 12 months, and also divided by the accrual period expressed in years. This is the formula which you can remember. Okay. Now let me very quickly give you the discount factors which I used. These are my discount factors for 3 months, 6 months, 9 months, and 12 months. You can actually use these values of these discount factors, input them into this formula, and quickly convince yourself that R fix is basically 1.8%. Okay. Now let's do this. Let's talk about valuation of an equity swap. When we talk about valuation, actually, we talk about how to value a seasoned equity swap. I mean a swap which has already been in existence for some period of time. Let's say I were to continue with this same example. Let me fast forward time by 1 month. If I were to do so, the share price of Apple, which at the moment was $200, might change. It'll become something else. And also my discount factors will change, both because interest rates 1 month from today might be different, and also these time periods till these 4 exchanges or settlements will also change. Okay, and this is what I have here. See, I have moved forward by 1 month. This is the point in time at which I am positioned now. Let me call it as time t. At this point in time, my share price of Apple has become 220, and these are my new discount factors. Okay, discount factors relevant for this point in time, which is lowercase t. Now, to find the value of this equity swap, again, let's say from the perspective of this investment bank, which is the equity payer and fixed receiver, again, what I have done is that I have used this trick of superimposing these dummy cash inflows and outflows. And again, I have made the investment bank achieve this liquidation value to be paid to the hedge fund by planning an investment into the shares of Apple at this point in time, and the size of this investment is again these many dollars. For this liquidation value, my investment bank will invest these many dollars at this point in time. For this liquidation value, my investment bank will invest these many dollars at this point in time. Okay, these are my 3 planned investments to take care of these three liquidation values to be handed over to the hedge fund. Okay, now for the liquidation value at this point in time, what should my investment bank do? At this point in time, the liquidation value to be handed over to the hedge fund, if you remember, was simply NA times S1 divided by S0, right? Now, this guy can be thought of to be the number of shares, and when liquidated at this point in time, this is the dollar value which can be realized. Now, to get this liquidation value, what the investment bank can do at this point in time is to purchase these many shares at whatever price these shares are trading at this point in time. And let's say at this point in time, the price in the market is ST, S sub T. Therefore, the investment required at this time to be able to realize this liquidation value at this point in time would simply be NA, notional amount, divided by S0, and this times ST. Okay. Now, to value this equity swap, very simple, just calculate the aggregate discounted value of these cash inflows. This is what I have here. From it, subtract the discounted aggregate value of these future planned investments. This is what I have here. And from this, also subtract the current investment at this point in time. And this is what I have here. Okay. Again, there will be lots of cancellations happening. Again, these cancellations are evident from this figure itself. This guy cancels with this guy cancels with this guy, and this guy cancels with this guy. Again, what we are left with as far as our inflows are concerned are the inflows which come from a hypothetical bond, a hypothetical long position in a fixed coupon bond, and the value of my equity swap is simply equal to the value of this long position in this hypothetical bond minus the investment as of today. These future investments have been cancelled out. Okay, this is what I have here. See, the value of this equity swap from the perspective of the equity payer and fixed receiver is simply equal to the value of this hypothetical fixed coupon bond whose coupon is equal to R fix. It was already calculated to be 1.8%, whose residual life at this point in time is 11 months. Periodicity of coupons is 3 months. Face value is NA, $10 million, minus NA times the price of my reference instrument, this stock at this point in time, divided by the price at the beginning of this period within which I am currently positioned, and that was S0. Okay. If you were to very quickly use the values in this table for the discount factors, use R fix to be 1.8% and use ST to be 220, S0 to be 200, you can very quickly convince yourselves that the value of this equity swap for this investment bank comes to around 0.7 million. Okay. This video was about understanding how to price and value equity swaps.